CEO of Efficient Lending Incorporated, and this is my first installment of what really is an important topic, and it's non-QM loans. And this three-part series that I'm doing is really going to be targeted for real estate agents in the marketplace. You really need to understand non-QM loans and how they can grow your business and how they're done properly. And you hear a lot about non-QM loans, the hard to close, the big issues, and things of that nature. But let me tell you right now, if you're working with the right lender and you've got the right professionals and real estate agents involved, you can do non-QMs very well, and really they're a really effective loan. This program is also targeted to buyers out there, especially non-traditional buyers like self-employed borrowers or high-asset, low-income borrowers and investors. So if you're in that category, check out this three-part series. I think you'll get a lot out of it. It's a great product, and it's a product really that if you're in this industry, you need to have a good functional working knowledge of. So the three-part series, the first part today, I'm just going to spend a few minutes describing what a non-QM loan is. Then the second part, we're going to talk about examples. What are actual non-QM products and how do they apply in the marketplace? And then the last installment is, okay, I think a non-QM loan is right for me if I'm a real estate agent or if I'm a borrower. What are the next steps? How do we engage non-QMs appropriately in the real estate transaction? So those are the three parts of this series. Let's start right in on what is a non-QM loan, and to do that, I think we need to define what QM stands for. It's qualified mortgage, and so when I say qualified mortgage, then what is it, how is it qualifying, and by what standards is it qualifying? And so to understand non-QM, let's first understand what a QM or a qualified mortgage is. Qualified mortgage came out of the Dodd-Frank legislation in the 2000s, right after the financial crash. And qualified mortgage is in conjunction with something called ATR, and ATR stands for ability to repay. Every lender must ensure that every loan we issue fulfills ability to repay rule. And that rule basically states that the lender, the investor, the broker, whomever, we must do the necessary due diligence to ensure that the borrower can repay the loan. We got to evaluate it. And if they can't, the lender or the investor will have certain liabilities against the loan should it default. However, if the lender does and the investor, the broker, does properly evaluate a qualified mortgage and fulfills ability to repay rule, then that investor, that lender, that broker will be granted a limit of liability as that loan goes into the marketplace. And so what do lenders and investors do then when we have a borrower that fulfills QM and ATR? Well, of course, the rates are lowered because it's a less risky loan. So let's start with ability to repay. There are 8 qualifications to fulfill the ability to repay rule that an investor or broker must evaluate. Those 8 are: number 1, current and reasonably expected income; number 2, your current employment status of the borrower or the borrowers; expected monthly mortgage payment; and then the 4th would be other mortgage payments like seconds, HELOCs, home equity lines of credits, liens, anything of that nature. Other related mortgage expense, think tax, HOA, insurance associated with the mortgage. 6 would be current debt obligations, including alimony and child support. Then you got the monthly debt to income ratio, and technically that ratio has got to be 43% or less. However, and I'm not going to get any more technical than I am, you will see QM mortgages in the 45% range, sometimes even higher. I'll let that sit there because it's more technical than I want to get in this video. And then lastly, obviously, you have to look at credit history. So once the lender or the investor has evaluated those 8 areas with the potential borrower or borrowers, and it's deemed that they fulfill ability to repay per the guidelines of Fannie Mae and Freddie Mac, then we go into defining the qualified mortgage. And a qualified mortgage, to be qualified, it must not have any interest-only components. So it's got to have principal and interest associated with it. Cannot be negatively amortizing. Negatively amortized loan is a loan that actually the principal balance will go up with a payment. We'll set that one aside too. There's actually places for that. It's pretty rare. Cannot have any balloon payments. It must be fully documented. So we've got to see pay stubs. We've got to see tax returns if necessary, asset documentation, identification, things of that nature. A QM mortgage must be 30 years or less. And generally, exceptions apply to this on lower loan amounts, but generally, points and fees can't be 3% of the loan amount. Okay, so now we've got a borrower that has fulfilled ability to repay, and they fulfill QM. So then the question becomes, what is non-QM? Well, let's think about this. What happened after Dodd-Frank is QM borrowers, meaning W-2 employment, salaries, not a lot of commissions, ton of money in the bank, so they fit assets, great credit history, things of that nature. Well, they easily fit the QM and the ability to pay law rule, but there's a segment of borrowers out there that are very financially stable. They have a lot of assets. They might have high assets, low income, probably self-employed, and they were excluded from the mortgage marketplace because they didn't fit this, what I call the QM box of ability to repay and QM loans. But they were individuals that were qualified and could responsibly handle a mortgage payment. So this industry came out of that called non-QM, or non-qualified mortgage. And so a non-qualified mortgage will be a mortgage that may not fit the QM underwriting guidelines, and or it may have some of those features that we talked about earlier. However, a non-QM loan, a non-qualified mortgage, still must fulfill the 8 requirements of ability to repay. And that is the reason why non-QM loans are really stable and safe and secure loans. Because what happens is when we get into the underwriting of a non-QM loan and we're doing the research and the documentation to make sure that we fulfilled those 8 qualifications, we're really doing an arduous underwrite. The broker, the lender, we really have to know our borrower. We have to know their financial situation. We have to provide this to the investors so that they can fulfill all the ability to pay requirements. And so one of the ways we do this is we may have stringent debt-to-income ratios. Has to be 43% or less. We may have stringent reserve requirements, meaning you have to have 6 months, 12 months, 18 months of reserves, liquid cash in order to qualify for the mortgage. And typically there'll be much higher down payment requirements. So for example, in a QM, Fannie Mae, Freddie Mac for non-first time buyer, you can have as little as 5% down. It's not the case in non-QM. Almost always it's 20% down required to be a non-QM loan. So a non-QM loan will have features that don't fulfill QM. We may not underwrite the same way as a QM loan with tax returns and things of that nature. We may use bank statements, for example, in a QM loan and a non-QM loan. But we have to fulfill the 8 requirements of ability to repay. And that's what makes a non-QM loan a really stable and good loan. If you're a real estate agent and you understand how these work and you're working with a broker, an investor, they can partner with you and get that borrower walk through the transaction safely and securely. And if you're an agent that can communicate how that works with the seller's agent, they can be great transactions. If you have professionals who don't understand that and how those loans work, then the transactions can obviously get a little messy. And that's not good for anybody. Okay, I hope that defines what non-QM loans are. Next installment is we're going to look at specific products in the non-QM marketplace and kind of how they work. And obviously, lastly, if you are a non-QM buyer or a real estate agent working these products, what do you do? How do you set the transaction up? Hope that helps. Thanks so much for watching the video, and we will talk to you soon.